What's up, guys? It's Sam, and I'm back at you with Robinhood and my Tesla options. With that being said, there's a link down below for Robinhood. Robinhood is a completely free trading platform. I didn't just put the link down there because I'm trying to get somebody to click on it and do something that I don't do myself. That's actually what I use. I got my girlfriend; she's using it now too. It's just completely free. So if you use like Charles Schwab, I used to use Charles Schwab. I've used TD Ameritrade. I've used E-Trade, and maybe one or two other ones. But it's absolutely free. It's fucking amazing. Anyways, so I have three positions open, and I talked a little bit about the one of them yesterday. Excuse me, but now I have the actual. Excuse me, I have the actual data here, and I just wanted to talk a little bit about the rationale or thinking behind this. If this is your first time here, make sure you press that like button. But back in the end of October 2018, I just moved from Florida to Massachusetts about 2 months earlier, and I had started a job, and I was getting up to speed. And at the end of October, I was really high, laying in bed, and I was like, "What the fuck do I want to do?" Right? Like, definitely don't want to work at this job forever. Hopefully somebody from my job watches this video, right? Hello. But literally, I just don't give a shit. If somebody does watch from my job, that's cool. I really don't give a shit. But that was the first thought. Was like, I don't want to work here forever. And what do I want to do? What's like the ideal thing that I would like to do? And I enjoy the freedom to do what I want to do with my time. I enjoy talking to people and working with people that I enjoy spending time with. But I also enjoy traveling a lot. So I created a kind of a budget of what I would need, right? And that's like $3,000 a month. It's actually substantially less than $3,000 a month. That gives me a large cushion every single month, about $1,000. So just to be conservative, I put it on there, and I didn't know how I would get there. My thought process originally was that I know you can make money through YouTube, and I know you can do like selling other shit and that kind of thing, but I enjoyed YouTube, and that was where I had a little bit of context because I had a YouTube channel. So I was like, I'll just start making YouTube videos, and I'll give myself about a year and a half to get that up to $3,000 a month, right? $100 a day. That would be I factored in about 1 million minutes watched on a monthly basis from YouTube, and that would probably supply, in my thought process, in the research that I did, about $2,000, and that extra $1,000 I would get from other miscellaneous things or rental property or whatever the case is. So that was what I had originally thought, and if you can go back, you can see some of these videos as well. And I already had used like the Robinhood app here, but one of the things is that with options, I actually have liked options ever since I learned about them in my senior year of undergrad. And then I learned more about them in grad school in multiple classes. And then I learned a ton about them with the CFA. Google if you don't know what that is, CFA. Also with the CAIA, which is another thing similar to the CFA, but just like extremely easy compared to the CFA. And more about trading with the CMT exams. CMT, CAIA, and CFA. So Google all those if you're interested. They're all in the finance realm. And it always intrigued me, but I never really put myself in the position to feel comfortable experimenting with my own money. So I created a couple different demo accounts, and then I actually followed through with one demo account. I think in 2017. And I did it for about 90 days. So it was TD Ameritrade. Thinkorswim is their trading platform. And they give you a demo balance of 50 grand. And within 90 days, I had doubled the balance of the $50,000. I wish I was making videos at that point so that I had that data to show you. And I doubled it in a relatively short period of time. And then 2 weeks ago, I decided to start. Trading options in Robinhood because there's no fees. By the way, if you do click on the link in the description and create your own account, you get a free share of stock, and I do too. But if you don't and you already use somebody else, that's cool too. I'm going to tell you exactly what I do here, and you can use the same strategy wherever you are. But obviously, this is not financial advice. Like, would you take financial advice from somebody who wears their hat sideways like this? Like, maybe you should lose your money if you take advice from people like this, right? So I started trading last week, and I just did very out of the money put credit spread on, I don't remember. Oh, Sirius XM. And I made like $8 last week. So I added another $1,000 in there. So the total amount that I have added into my account was around $2,100 or $2,300. I don't remember what it was. And but in that neighborhood, $2,100 to $2,300. And then I was like, well, last time when I was trading with TD Ameritrade Thinkorswim, I was using Tesla options. And first of all, if you don't know what options are or like have any modicum of understanding of what they are, they're super, super interesting. And I view options like if you were to take, say, an X and Y axis, right? And you put complexity, and don't hate me if my spelling is off on these. And then you put number of people, right? So you have an XY axis, and you put the total number of people and complexity on the scale right here. You would have something like this, right? You'd have something like this, right? And what that says is the more complex it is, the less people do it, right? So if you have something that's really easy, a lot of fucking people do it. And so what ends up happening, right? People think options are complex, and obviously this is coming from a skewed frame of reference, right? Like I just let you know that I was intrigued by options back in undergrad. Excuse me. I have an MBA in finance and in accounting. I was intrigued with options throughout my MBA. I have a CFA. I was intrigued with options the entire time I was doing that. I have partials for the CAI and CMT. Like, I just found them very interesting over the years. And so when you have that type of background, maybe it comes from a bias, right? Where somebody else coming from a different type of background might see them as completely fucking ridiculously complex. So another thing, when you look at, say, another XY axis, right? And if on this, on the XY axis, you add, like, I'm just going to call it money, right, on the horizontal axis. And on the vertical axis, what does it say? Money and not all the time, but we'll put complexity over here again, right? So this being very little and this being a lot of money, right? And this is definitely not the case all the time. But when you really think about it, right, in any type of business, whether that's a commodity type business or something else, the people who are successful understand the complexity of the little nuances, right? Like there doesn't have to be complexity in terms of financial options, right? Like that might be very complex to some people, but the little nuances of human behavior, maybe that would be complex to one type of person, but to another person it is super easy, and they are able to grasp and understand those things to be an amazing fucking salesperson, right? So if you have complexity, and the graph for this, right? And I like to think of these things as more exponential. I don't like to think of them as linear. By the way, if you don't know what exponential means, that's just like if you have an axis that goes like this, that would be like linear. If you have one that goes like this, that would be exponential. Just FYI. So this is a slight exponential curve right here. But as you can see, as we go up in complexity, you tend to make more money from whatever it is that you're doing. And that doesn't necessarily have to be applied, as I mentioned, to this. Like, whatever you do in your business, like, if you work at McDonald's, and there's nothing wrong with McDonald's. Like, my brother worked there for years and years and years, and he's fucking amazing. Like, I'm not saying there's anything bad about that, but if you work at McDonald's, right, the complexity of flipping a burger, think of that, right, versus the complexity of running the restaurant versus owning the restaurant, and the different levels of complexity that go on within that, right? And at each level, you end up making more money, more than likely, right? Not all the case, but it tends to be that way if you're good. And so when you put both of these on top of each other, it looks like an X. That's kind of cool. That was about it. Now getting back into options trading. I didn't have a point in that, really. That was it. I just wanted to look at what it looked like on top of each other. It's an X. See? Definitely don't take fucking financial advice from somebody who does that shit. I would say that is probably not a prudent idea. Anyways, okay. So with options, the vast majority of options are... Talk about that transition, bro. Thumbs up for that transition there. The options, the vast majority of them are not exercised. And the vast majority of them are not in the money, meaning that the owner, the purchaser, loses out the premium. And remember, not everybody's trading options for the same reason. Some people use them for income. Some people use them for speculation. Some people use them to reduce risk, mitigate risk. Some people use them to actually enter into a position, right? Like if you wanted a position in Tesla, you could get something, you could get a option, sorry about that, that would be exercised to allow you to get into a position if you were to take like a short position on something, and then you'd be required to purchase that, but you took in the premium, so you actually get to purchase it at a discount. So it's a way to enter into positions as well. So not everybody is trying to go through and trade options to make money from that. Just remember that there's many different types of players in the market who have differing points of view on what they are trying to accomplish by doing this. But to generate income, right, that's what I want, right? That's why I told a whole context story about what I'm doing in terms of this stuff online to create a source of income. By the way, if you subscribe, I do make videos on that, my weekly progress and or monthly progress in terms of the money I've made. So with options, you when you sell something, you take it a premium. So I wanted to just go over this one example here. If you look at this is the 250, 235 puts for Friday. Today is the 20th of March. Friday is the 22nd of March. So that means that these puts expire. This is how it's going to look, right? 250 slash 235 puts, and they're 14 cents. And what 14 cents? You're like, that's super cheap. Well, yeah, it's times 100, so it's actually $14. But what? And you can see that actually it comes up right down here. Check that out, $14. Because it's times 100 shares. This is a way to like add leverage to a portfolio too, because it's times 100, whatever it is. So that's a way to add leverage in an efficient manner, or in a very idiotic way if you don't know what you're doing. So if you pull down here, right, the position, I have -1. Whoa. I have -1, which means I have short one of the. I shorted the 250. I shorted the 250, and I purchased the 235. So the difference between those two, the one that's 250 has a higher price, and then the one that's further away from the stock price. If you look down there, the stock price is 273 and change. So the one that's closer to the actual stock price in the market, whatever it is, this is Tesla I'm talking about, but whatever you're trading on, if it's closer to there, it's going to be more expensive than if it's further away from there. And the average credit, meaning the delta between those two, between what I sold and what I purchased, between that, excuse me, is how much I take in terms of cash, which was 92 cents. But we just learned, remember, the 92 cents is times 100 shares. So I took in $92. And how much is the position worth? 14 cents. So $14. So if you go through and you do that, what is that? 92 minus 14, that's $78. And I open this position. It should tell me here in the notes. Last week, it was last Friday or Monday. Where the fuck is this? Sorry about that. Where is this? Anyways, I think it was on Friday or Monday. I have to look at my actual trading history to figure out when that position was opened. On the 18th, it says. So the 18th was Monday is when I opened that position. So I opened that position on Monday, and I received $92. So what that does is it holds, and I'm just getting back familiar with everything, so just correct me down below if I'm wrong. It holds the amount that you would potentially lose on that position as margin. That seems very simplistic, so please correct me down below if I am incorrect in terms of that. But the maximum loss on that position would be the difference between the 250 minus the 235, which is 15, right? But that's minus the 92 cents that I took in. So that's 14.08, right? Because we took 92 cents off the $15 between the two exercises, or strike prices. And so the maximum I can lose on this is 14.08. But you're like, Sam, you only made $100 and you could lose 1,400. Like, that doesn't seem like a good ratio. However, from the very elementary understanding, you could be like, yeah, that's a bad ratio, right? 14-1. But the next logical question would be, what's the probability of something like that happening, right? Because it doesn't matter if it's 1-1 or 14-1. What's the probability of something happening like that? So if you, and I'm working on putting this together, but if you looked at, say, the average standard deviation of price flexibility, or the price volatility over the, say, the last 30 days and 1 year, or, you know what I mean, whatever time period you wanted to look at, or look at a couple time periods, you could take look one standard deviation or two standard deviations or three standard deviations and go outside of that, right? The volatility of the price of a stock is not exactly like a bell curve. It's actually got fatter tails if you look at the research, but what that means is it's going to be very similar to a bell shape. So you're not necessarily going to capture like whatever it is within two standard deviations of a normal bell curve distribution, which is like 90 something percent of that, and 3 is like 99%. But if you do that, remember this is not a normal bell curve, so you're actually going to have a fatter tail than that 1% split between both sides, right? But that's essentially the way you could think about this to help put yourself into a position where you have a lower probability of something like that happening. Anyways, I got a little bit off topic on this video with the complexity and the money you make, and you put an X on top of it. So what you should do is you should just X that bell notification so that YouTube will tell you every time I post a new video. Don't forget to like this button, like this video. If you guys have any questions, though, on a serious note, let me know. My portfolio value in terms of, we'll just say I put in 2,300 to be conservative. And if I get over here to my actual account, right, I'm going to just cover up the account. I think this is the account number here at the top or whatever. But you get to see the total right there is cash is $2,766. So, that's not, like I only put in, $2,200, $2,300. So that's a pretty substantial return. And I just started trading options. This is obviously could be an anomaly, but I will continue to show you the results. By the way, the portfolio value is this number here, and the cash value is that number. And you're like,